Good afternoon, Mark here from Success with Options. In this set of videos, I'll be providing an overview of iron condors. I'll be providing some concepts via slides, but then I want to jump into a trading platform to put on an actual trade. Let's start by talking about what an iron condor is. The term may sound odd or even intimidating, but it's really not that complicated. An iron condor is really just two short vertical spreads put together. One is a short call spread and the other is a short put spread. The basic iron condor has the same number of contracts on each vertical spread, and the spread is the same on each side. That's a balanced iron condor. There are, of course, variations that can be created from there. If you're new to short vertical spreads, you may want to have a look at the vertical spread videos or the material on the website first. The standard iron condor is pretty much a neutral strategy. Since there is a short call spread on the upper side and a short put on the lower side, the typical expectation is that the underlying instrument will remain in a fairly tight range. This trade is not a good one to use in a strongly trending market because it's usually the case that one side or the other gets completely run over. Let's look at an example of an iron condor implemented on the SPY, an ETF of the S&P 500. As I mentioned, the iron condor is made up of two short vertical spreads. First, a short call vertical spread. In this example, let's make it a $2 wide spread. The red line will represent the short strike, while the green line will represent the long strike. We also have a short put vertical spread, also a $2 wide spread. Notice here that the short strikes are closer to the current price while the long strikes are farther away. Knowing how short vertical spreads work, what would you expect the range of profit to be? Our range of profit is going to be the area between the short strike prices. As long as the underlying stock or ETF remains between these 2 points on expiration, the trade will achieve maximum profit. That leads us to some additional points about iron condors. The maximum profit on an iron condor is the credit received when selling or entering the position. The maximum risk will be the width of the spread on one side minus the credit received. In our prior example, the width of the spread was $2. If we received $1 in credit when entering the trade, then our risk is only $1 of our own money that we might lose if the trade goes completely wrong. Ideally, we'd like the trade to expire with the underlying somewhere between the two short strikes. However, we'll often not wait for expiration. I'll talk more about exits later. Iron condors are a relatively delta neutral trade, meaning they initially won't have a strong bullish or bearish bias. They also have positive theta, which means that they benefit from the passage of time. Since there are two vertical spreads, you have twice the time value melting away. Iron condors are also negative vega trades. That means they will benefit from the decrease in volatility, or be hurt by an increase in volatility. I like to trade iron condors for a number of reasons. First of all, I'm basically getting twice the credit by selling two vertical spreads but only tying up margin on one side. Why? If you think about the iron condor diagram several slides back, you can see that it's physically impossible for the underlying stock or ETF to expire completely through both the call spread and the put spread at the same time. For that reason, most brokers only hold margin on one side. Second, as I mentioned, iron condors are theta positive trades with defined risk. That means I have a trade that benefits from the passage of time and I know exactly what I'm risking in the trade. Finally, even though iron condors are essentially a neutral trade, they can take advantage of the natural ebb and flow of price fluctuation. Let's take a look at a couple of examples of trading iron condors. This first example is the best case scenario. In this trade, I sell my short strikes above and below the current price. I enter the trade for $1 credit. Several days later, the market has moved up and is threatening the upper spread. However, because of the move, the value of the put spread has decreased such that I can buy it back for 20 cents. Now let's say sometime later the market sells off again. Since I no longer have the put spread, there's no longer any risk to the downside. With the sell-off, I can now buy back the call spread for 20 cents and close the entire trade out. Now let's analyze this trade. I put on a $2 wide iron condor. That's two $2 wide vertical spreads. I receive a credit of $1, leaving my maximum risk in the trade at $1. I close the trade in two phases for a total of 40 cents, leaving a net profit of 60 cents. That's an ROI of 60%. That's my 60-cent net profit divided by my initial risk or margin of $1. Let's now take a look at the worst case scenario. We start with the same trade. The trade is initiated for $1 credit. The market moves up as before. That allows me to close the put spread for 20 cents. However, instead of selling off, the SPY continues to rally and eventually runs through my call spread, and I experience the maximum loss on that part. Let's now analyze this trade. I put on the $2 wide balanced iron condor for $1 credit. I still have the same risk initially of $1 in the trade. Since the SPY closed completely through my call spread, I had to pay $2 to close that part of the spread, plus the 20 cents I paid to close the put spread, making my total cost to close the trade $2.20. That makes my loss in the trade $1.20. Now that's slightly more than my initial risk I mentioned. That's an important point to make because the initial max risk doesn't mean I couldn't lose more if I made some sort of trade adjustment as I did. It's important to take exit strategy into consideration when considering the risks of the trade. This brings us to exiting the iron condor. I want to talk about different approaches to exiting an iron condor. We'll revisit some of these later as we go through an actual trade. Now, one approach I could take is to simply let the entire trade expire and deal with the settlement at that time. Either it will expire worthless, or I'll have to pay something because the underlying is all or partially through one of my spreads. This can be pretty risky, actually. I can also close the entire iron condor position at any time simply by buying it back. I can set up a trade rule to do so if I can lock in some percentage of the initial credit. I could also close the entire trade if I hit some sort of loss limit, meaning I have to pay some amount more than my initial credit to close the trade. I could close out one side at a time, as we saw illustrated in the previous trade examples. The exit strategy will often depend on the trading strategy being employed. It's important, though, to have a set of rules for exit so they are easy to understand and easy to follow. Let's now talk briefly about some different strategies for trading an iron condor. These are by no means the only ones, but they do represent the ones I either do trade or have traded in the past. The first strategy is what I call the 60% probability iron condor. I call them that because I'm targeting to sell the short strikes for each of the individual spreads at a 60% probability or so of expiring worthless. In this strategy, the goal is only to grab the majority of the time decay, not the entire amount. This strategy will pay a larger credit, but the probability of success is lower. That's why I don't hold out for the entire credit. I'll manage the risk by closing the trade early with the majority of the credit locked in. Another strategy is what I call the 90% probability iron condor. The strikes here will be further out of the money and have a higher probability of expiring worthless. The goal of this strategy is to go with the probabilities. Since this trade is successful more often, I'll usually let the trade go longer and try to get most of the credit, which is obviously going to be less than the previous strategy. One risk of this kind of trade is that if wrong, the risk reward will be quite a bit higher, so it's important to manage these trades more closely. Another strategy I've used is one I call legging in. It's more of a hybrid approach where I won't put the call spread and the put spread on at the same time. It can be riskier in that you may actually not get as good of a price as if you'd have put the entire trade on in the first place. I often employ this technique when the market is trending more, and often I just start out with an initial vertical spread and then decide to put the other one on as a more opportunistic trade. This part of the overview has been pretty much slides, but I wanted to make sure I laid out the groundwork before going into the actual trade examples. In the next video, I'll actually be going through an example of employing one of the strategies and using the platform to select, analyze, and enter the iron condor trade. Thanks for watching, and happy trading.